Hi, I'm Chris Atkins, C2FO Capital Finance. I'm here with Paul Durosko, our head of underwriting. We're going to talk a bit today about credit and underwriting in today's economy, especially as it relates to the pandemic and being a participant in C2FO's network. Paul, from a high level, tell us a little bit about your background.
Sure, I've been in secured financing for about 30 years. Started out an accountant in trade and then moved up into collateral auditing and then into lending. I joined C2FO in February 2020 and really looked to bring some of the older school credit disciplines to the young fintech nature of CapFin and C2FO.
You've been in the finance space for a long time. What makes the pandemic in 2020 different?
I think the biggest difference, say from 2008 or even prior to that, is the economy went from 60 miles an hour to zero. It just stopped. In 2008, in other recessions, we were able to proactively begin to reduce exposures. We were able to affect advance rates. We were able to establish reserves. Again, begin to kind of throttle down. Here, we didn't have that time. We had to really kind of proactively react, if that makes sense, because we had to understand, how our portfolio was going to react in that type of a full stoppage.
And how has the portfolio reacted?
The portfolio reacted tremendously. We did a lot of things really quickly. We went in and we immediately began to parse the portfolio by industry, by essential, non-essential, even before everybody was talking about non-essential and essential. We began to parse that and break that up. We had conversations with every one of our borrowers, very scripted, very specific conversations, and we talked about their source of supply, what existing inventory they had, how were they going to be able to weather, whether this was going to be 3 weeks or 3 months or a year. We talked about our debtors, we talked about concentrations and things like that, and really we got a lot of different perspectives which helped us to evaluate the portfolio, and happy to say that because of that granularity, the portfolio has performed very well.
And is that just because we kicked everybody out, or did folks change the way they were maneuvering their business in response to those questions, and we kind of helped them?
They did. They did. And one thing I will say is as the economy was going 60 miles an hour, we didn't reduce or eliminate our credit standards. We maintained our credit standards. So the good operators in the portfolio were able to step back and evaluate, number one, the effect on volume, number two, the effect of their variable spending and expense burden, and the good operators began to adjust those levels. And you could see it, and we could see it in some of the financial performance. We had some customers who were able to shift their model a little bit. One of our customers successfully maneuvered into a real COVID-related disinfectant and has been very successful. I think he's tripled his volume in the last 3 months. So again, it goes back to the due diligence that we did up front, the good operators and the trust. Everything was very cooperative, collaborative with our borrowers.
It sounds like you've got some good operators in the portfolio, but what do you attribute that to?
We really do, and they're smart operators who are using our network on the early pay side right now, so they understand cash flow and they understand discounting, and to have them come over to us in certain times of need has been a very nice surprise.
What are you hearing in the market? What are other banks and non-bank lenders doing in the market right now?
Banks have been a little less flexible in terms of extending payments and providing availability. What I am hearing on the bank side is while they have to bolster their reserves for potential losses in their capital, they are moving a lot of deals and trying to move a lot of their deals into their workout area and then ultimately out of the bank, which is good for your alternative lenders who should be sitting right there ready to help those borrowers. So it's a good area for alternative lenders to take a look and see if there's something they can provide in terms of working capital for some of those borrowers also.
Yep. And the big question I'm sure is on a lot of people's minds in terms of the CARES Act and all of the help from the government from a monetary standpoint. How's that affecting both the portfolio, but then also how you think about new applicants?
Another reaction that's different this time versus other recessionary periods is the fact that the government did come in with the CARES Act, and they're very aggressive in terms of both the PPP and the EIDL loans. We encouraged our borrowers to apply for PPP where it made sense for them. What we saw in the portfolio immediately after the CARES Act and some of the loans is lower utilization in the portfolio. Those folks using that PPP as they were supposed to and to run their businesses, and that brought their borrowing needs down a little bit, which helped them in their variable costs, saved them a little bit of interest. So while we didn't love to see the lower utilization, it was good for our borrowers, and that ultimately is good for us.
How do you think about underwriting standards, kind of here going forward with the inclusion of the pandemic in your calculus, but also, in the near term that we could maybe go back to stay-at-home orders, and how do you think about that too?
We've maintained that granularity of our due diligence at the debtor level, and one of the products I've really fallen in love with, and it's an old product, is the ledgered ABL product. And what I really like about that is again, that granularity with the debtors and the invoices. And it really allows us to know who our customers' debtors are. So in one sense, there's a lot of uncertainty. In the other sense, we've seen the last 6 months of how that's worked.
Let's fast forward to 2021, where we're sitting in a period where you're then looking back at 2020. Most people are going to say, yeah, I felt like I could have done better until COVID. How do you think you're going to look at it, at the period of 2020 into the future?
Yeah, and it's interesting because, prior to 2020, one of our credit questions was always, well, how did you do in 2008? And how did you do in that recession? And we always want to understand how they reacted during those times. This slowdown has been a lot different, as we talked about. And I think that there's going to be two different level evaluations. And I think the first level is going to be, how did you perform during the COVID and the pandemic and the shutdowns? How did you react? How did you manage your P&L? And I think the second analysis then is, how were you operating before the pandemic? And I think you need to take the two of those to try to put those together and understand what the future holds for any particular customer. So I think it's kind of a two-level analysis. I don't think you can completely throw away what's happened in 2020 because business did continue and folks were operating. And as we talked about, there were some successes. And so I think you need to evaluate a pre and a post, if you will, to really understand how a company is going to perform in the future.
What can business owners and business executives be doing now to look better in 2021?
I think they can make sure that they're buttoned up on 2020. They would want to make sure that the narrative they tell for 2020 is supported by the financial performance and the collateral performance. I think that they should have the narrative, how they what they were doing before, how they transitioned through it, and how they're going to transition into the future. And I think being able to tell that story supported by facts and data would go a long way.
Tell me why you joined a fintech.
What I really liked was merging my kind of old school lending and credit disciplines with the new fintech approach. I kind of wanted to move away from kind of the old way of doing things and move towards a better way to do it.
What are some of the kind of older world ideals that we're still applying?
From an old school disciplines and credit standpoint, we continue to have first lien positions on all the assets. We continue to evaluate the company and its model and its financial performance. So we're still trying to marry all of those disciplines with just a better and faster way to do it.
For a company that's selling into a large corporate, that's how they're in our network. How do they typically think about finance, about working capital finance, about cash flow? And how does that kind of relate with us?
Yeah, a lot of our prospects on the other side, they do a lot of different things, and their focus is, as it should be, is on running the business. And what we want to do is we want to take the cash flow and worrying about cash flow out of their hands. So we build that trust with them, and they're running their business. And we're worrying about the cash flow, and we're making sure that the collections come in and the proceeds and the remittances are properly applied. And
In the same way, bringing on a key manager would be helpful to an entrepreneur.
Absolutely, and we save them that additional cost. In most cases, it's an SMB or a smaller business, and they don't have the resources and the depth. So we kind of step in and provide a little bit of that for them.
Will you describe from just a high level the process? So if I'm an applicant, what should I expect from the underwriting process at C2FO?
The first thing we do is we collect a little bit of data, and we'll take that information and we'll put that into what we like to call a pre-screen kind of a memo, where I sit down with the team and we go through the financial performance, the collateral performance. So we go through pre-screen process, we go to a term sheet, and if a term sheet is then issued, that goes back to sales, and our sales folks will contact and speak with the prospect about the terms, perhaps some of the conditions. So we do our due diligence, and then ultimately we get to a process call, and we just go through with the prospect, what is your model? We like to understand how they invoice, and are they using portals? Are they using EDI? What type of verification are we going to undertake? From the invoicing call, we do put a credit memo together. We do go to credit committee, hopefully receive approval. When we do get approval from the customer, we move very quickly to sign our documents. And from our documents, we then will have an implementation call where we will introduce them to what they're going to see on their end from a platform standpoint. Once we finish those, we move to a funding, and that's really the process. We're trying to compress that, every day.